Welcome to another session of Equicapita's Little Book of What Next webinar series. Thanks for joining us today, Stephen Johnston and myself, Michael Cook. In addition to talking to you folks about chapters in our book, Little Book of What Next, we also want to address some of the topical issues in the news that we're seeing. And one of the things, Steve is a highly regarded economic thinker in Canada, and we wanted to touch on some of the relevant economic themes that are in the market today, and one of which is China and China's impact on the economy. And I know, Steve, you often get asked, what is the impact on the economy of China's liquidation of their Treasury holdings?
Yeah, and it's a really interesting question. You see in the media, there's certainly a view that's prevalent, I would say, that China liquidating its Treasury holdings to fund, its current account deficit and all the things that are happening currently in its economy will have deflationary effects on the West. And I guess the main driver that people perceive this to happen by is the fact that they sell Treasuries, which drives up interest rates, which has a depressing effect on the economy, a deflationary effect on the economy. But actually, and certainly it's something that we've discussed internally because it has some impact on what we do as investors, we take absolutely the opposite view. If you think historically, what China was doing when they acquired those treasuries was sterilizing U.S. inflation. The U.S. was printing money in order to, China was running a mercantilist policy of maintaining a low exchange rate with the United States in order to maintain its exports. And so it was acquiring U.S. dollars, converting them into local currency, and then using that getting the local currency, converting into dollars and acquiring treasuries. So it was effectively sterilizing all that monetary expansion in the United States. It was importing U.S. inflation. Well, of course, if it was importing U.S. inflation when it was accumulating treasuries, then it's now exporting inflation when it's divesting treasuries.
Okay.
I mean, that's the other side of that equation. And so, as much as it may seem counterintuitive, by divesting treasuries, accumulating dollars, and selling those dollars in order to convert into local currency to support local economic initiatives, it's actually sending those U.S. dollars back to the West, which is inflationary.
Right, okay. That makes a lot of sense.
Yeah.
And then the flip side of it is in China, which we have much less interest in. What impact does that have on their economy, obviously?
Well, the argument there is, of course, that if they're exporting inflation, now they're starting to import deflation, right? And that's actually what you're seeing in the Chinese economy. You're seeing a contraction in their economic development, which they're rapidly struggling to try and offset here. And so we do live in interesting times, but as far as investors, and certainly investors that are focused on Western Canadian companies, I would argue that this current cycle, in the foreign exchange market and in the U.S. Treasury market may have some very unexpected inflationary consequences for investments. And of course, the things that we're invested in, to a large degree, are inflation hedging, and so it should have positive impacts on our portfolio.
That's very interesting. I'm glad we addressed that today. Thank you, Steve.
Thank you, Mike.